Hey, what's up everyone? Welcome to the channel where we dive deep into mastering financial freedom through the best tips and tricks out there. Today, I've got a real treat for you. 8 assets that can make you real rich. And no, we're not talking about boring or high-risk gambles. These are real, solid, income-generating, low-risk assets that appreciate over time. Sounds too good to be true? Well, it's not. So if you're looking to boost your income, build lasting wealth, or even retire early, stick around, hit that subscribe button, and let's dive in. But before we get into the juicy details, let me hit you with something wild. A few years back, some Western countries ran an economic experiment that shocked the world. They gave out super cheap loans to almost anyone who wanted them. Yep, practically handing out money. Why? To catch up with China's insane economic growth. With China becoming a rising global powerhouse, countries like the US, Switzerland, Denmark, and Japan wanted to stay in the game. Their plan: make money more accessible to boost local businesses, real estate investments, and consumer spending. It was all about global economic competition, and this move made banks, investors, and governments step up in a major way. Now, let's get to asset number 1. Real estate. Not the kind you live in, but the kind that makes you money. Real estate is powerful because it can generate rental income and appreciate in value. Say you buy a property that gives you $2,000 a month in rent. That's $24,000 a year. Add an annual appreciation rate of 8%, and you're watching your wealth grow in 2 directions. Investing in multifamily real estate, like duplexes, triplexes, or even full-blown apartment complexes, can be a game changer when it comes to rental income. Unlike single-family homes, these properties allow you to earn from multiple tenants under one roof, effectively multiplying your cash flow potential. Yes, managing multiple tenants comes with more responsibilities, from maintenance requests to rent collection. But with the right systems in place, the increased income often outweighs the added workload. Likewise, commercial real estate covers a broad spectrum. Think office buildings, retail shops, restaurants, or industrial warehouses. One of the biggest advantages here is the long-term nature of commercial leases, which can bring in more stable and predictable income compared to residential properties. Tenants are often businesses, meaning fewer turnovers and a more professional relationship. However, the entry cost is typically higher, and managing commercial spaces requires a good grasp of zoning laws, property upkeep, and market trends. Still, for those who can understand the complexity, the rewards can be substantial. The short-term rental market is booming, and platforms like Airbnb and Vrbo have made it easier than ever to turn properties in tourist hotspots into cash machines. Vacation rentals can command premium prices during peak seasons, especially in desirable destinations. The flip side: they do require more hands-on involvement, guest communication, property cleaning, and constant turnovers. But if you're up for a bit of hustle, vacation rentals offer a flexible and often lucrative income stream with the potential for very high returns. Land might not be the flashiest investment, but it's one of the most strategic. While undeveloped land doesn't generate immediate rental income, it can appreciate massively over time, especially in areas slated for future development. Buying land near expanding urban zones, proposed infrastructure projects, or growing suburbs can turn into a gold mine. Of course, it requires due diligence. You need to research zoning regulations, environmental restrictions, and future development plans. But when timed right, land investment is like planting a seed that grows quietly, and sometimes explosively. For those willing to venture beyond the traditional specialized real estate, offers some intriguing opportunities. This includes self-storage units, mobile home parks, RV communities, and even parking lots. These niches might fly under the radar, but they cater to consistent demand and often come with lower maintenance compared to residential properties. For example, self-storage facilities require minimal tenant interaction and low overhead, yet can generate excellent cash flow. The key here is understanding what drives demand in your chosen niche and managing it efficiently. Likewise, if you're more experienced and have access to capital, real estate development can unlock serious wealth. This means building new properties from the ground up, or renovating existing ones for resale or rental. Development is where creativity meets business strategy. You shape the project, control the outcome, and potentially walk away with large profits. But make no mistake, it's also high risk. You'll need knowledge in construction, permits, design, budgeting, and market demand. Done right, development can turn you from a property owner into a value creator. Let's talk about financial instruments, things like bonds, mutual funds, and other paper assets. They might not sound flashy, but they're solid. For example, putting $10,000 in a bond with a 5% annual interest rate earns you $500 a year on autopilot. Government bonds are the classic go-to for conservative investors. Issued by national or local governments, they are widely considered low risk, especially when coming from stable economies. US Treasury bonds, for example, are often seen as a benchmark for safety. While the returns may not be huge, typically between 2% to 5% annually, they offer consistency and peace of mind. A $50,000 investment in a 10-year Treasury bond with a 4% yield would earn about $2,000 annually in interest. Reliable income, with very little drama. Corporate bonds are debt instruments issued by companies looking to raise capital. They're riskier than government bonds because they depend on the financial health of the issuing company. However, this added risk usually comes with higher returns. Investment-grade corporate bonds might yield 3% to 6% per year, while high-yield or junk bonds can go beyond 7%, though these carry a greater chance of the issuer defaulting. Municipal bonds, or munis, are issued by state and local governments to finance public projects like schools, highways, and water systems. These often come with a significant perk. They're usually exempt from federal income taxes, and sometimes even state and local taxes as well. This makes them particularly attractive for investors in higher tax brackets. For example, a municipal bond yielding 3% might be equivalent to a taxable bond yielding 4.5% for someone in a 33% federal tax bracket, making them a smart, tax-efficient choice for long-term stability. Equity mutual funds pool money from many investors to buy a diversified portfolio of stocks. These funds are managed based on specific strategies. Some focus on growth stocks, others on value, or small cap versus large cap companies. Historically, broad equity mutual funds have delivered average annual returns of about 7% to 10% before fees, though performance can vary widely year to year. A $10,000 investment in an S&P 500 index fund with an average annual return of 8% could potentially grow to over $21,500 in 10 years, not accounting for taxes or fund expenses. Bond mutual funds operate similarly, but focus on fixed income securities like government or corporate bonds. These funds offer diversification within the bond market and typically provide annual returns in the range of 2% to 6%, depending on the types of bonds held and the prevailing interest rates. They're ideal for investors looking to earn steady income while spreading risk across various bond issuers and maturities. Balanced mutual funds aim to offer the best of both worlds by investing in a mix of stocks and bonds. A common allocation might be 60% equities and 40% fixed income assets. These funds are designed to balance growth and income while reducing overall volatility. Historically, they've returned somewhere between 5% to 8% annually, offering a solid middle ground option for investors who want moderate risk with decent returns. Exchange-traded funds, or ETFs, function like mutual funds in that they pool investors' money into a diversified portfolio. However, unlike mutual funds, ETFs are traded on stock exchanges like individual stocks, allowing for more flexibility in buying and selling. They often track specific indices, sectors, or asset classes, and usually come with lower expense ratios, making them a cost-effective way to invest. Their returns closely mirror the performance of the underlying assets they represent. Certificates of deposit, CDs, are fixed-term savings instruments offered by banks and credit unions. They come with a set interest rate and maturity date, making them a predictable and safe investment. CDs are insured by the FDIC or NCUA, depending on the institution, which adds another layer of security. Interest rates for CDs vary, but generally range from 1% to 5% annually, depending on the term length and economic conditions. Money market accounts offer a liquid and low-risk place to park your cash while earning a bit more than traditional savings accounts. They invest in short-term, high-quality debt instruments and typically pay interest in the range of 0.5% to 3% per year. While the returns aren't thrilling, the quick access to funds and minimal risk make money market accounts a reliable choice for conservative investors or those building an emergency fund. Now buckle up, because we're entering the exciting world of stocks and digital currencies. Stocks allow you to own a piece of successful companies, while digital currencies like Bitcoin offer high-risk, high-reward opportunities. Investing in stocks means owning a slice of a publicly traded company, literally becoming a shareholder. Your potential returns come in two main forms: capital appreciation, where you sell your shares for more than you paid, and dividends, where some companies share a portion of their profits with you regularly. Together, these elements offer both growth and income, depending on the types of stocks you invest in. Blue-chip stocks are often the bedrock of a solid portfolio. These are shares in large, financially stable companies with strong track records and regular dividend payouts. Think Apple, Microsoft, Johnson & Johnson, or Procter & Gamble. While they may not provide the explosive gains of more speculative picks, their reliability and steady performance make them appealing to long-term investors. Historically, blue-chip stocks have delivered annual returns in the range of 7% to 10%. If you had invested $10,000 in a diversified group of blue-chip stocks 2 decades ago, your portfolio might be worth over $40,000 today, depending on the specific holdings and market trends. Then, there are growth stocks, which belong to companies that are rapidly expanding, often in cutting-edge sectors or offering revolutionary products. These stocks usually don't pay dividends, as the companies reinvest their profits into further growth. Tesla and early-stage Amazon are classic examples. Growth stocks are more volatile, but the upside can be enormous. Returns of 20% to 30% in a strong year aren't uncommon. That said, the downside is just as real, and price swings can be nerve-wracking for the faint of heart. Value stocks represent a different strategy. These are shares in companies that are considered undervalued by the market, trading below their intrinsic worth. They might be in slower growing sectors or facing temporary setbacks, but savvy investors see opportunity where others see decline. When the market eventually corrects and these stocks catch up to their real value, returns can be impressive, often in the range of 10% to 15% annually during recovery periods. You can also focus on specific sectors, tailoring your investments to particular industries such as tech, healthcare, or energy. Stocks like Nvidia, United Health Group, or ExxonMobil reflect broader trends in their fields. Tech has been a high-growth sector over the past decade, with some companies consistently delivering annual returns well above 15%. On the more speculative end of the financial world sits digital currency cryptocurrencies that operate on blockchain technology. The most famous, of course, is Bitcoin, often referred to as digital gold. Bitcoin has a fixed supply of 21 million coins, which creates scarcity and drives demand. Its value, however, is anything but stable. Bitcoin is notorious for wild price swings. In 2025, it surged to nearly $100,000 before plummeting. Annual volatility can easily exceed 50%, making it a high-risk, high-reward asset. Ethereum brings something a little different to the table. Beyond being a digital currency, is also a platform that supports decentralized applications and smart contracts. That added utility gives Ethereum a unique position in the crypto world. Like Bitcoin, its price is highly volatile, frequently seeing double-digit shifts in short periods. Still, its technological use cases have attracted a strong following and long-term investment interest. Then, there's the vast universe of altcoins. Basically, any cryptocurrency that isn't Bitcoin. These range from serious contenders like Cardano and Solana to ultra-speculative tokens that can rise or fall by 20% to 50% in a single day. Some altcoins offer groundbreaking tech or niche applications, while others are little more than hype-fueled gambles. Investing here demands careful research, strong nerves, and an appetite for risk, as the potential for both massive gains and catastrophic losses is very real. Let's pivot to something classic, yet golden: commodities. We're talking about gold, silver, and energy resources. These have been valuable for centuries and offer a hedge against inflation. Imagine investing in silver at $20 an ounce and watching it rise to $30. That's a 50% return. Gold and energy resources are not only practical, they're also stability anchors during economic uncertainty. Precious metals have long been seen as timeless stores of value, and beyond the usual suspects like gold and silver, other metals play significant roles in both investment portfolios and industry. Platinum, for instance, is highly valued not only for its use in jewelry, but also for its critical role in industrial applications, particularly catalytic converters in vehicles. Its price is closely tied to industrial demand and supply scarcity, which makes it more volatile than gold. In the early 2000s, platinum prices soared above $2,000 per ounce during a period of strong economic growth and high demand from the auto sector. However, like many commodities, its value can sharply decline during economic downturns when industrial activity slows. Palladium shares similar traits with platinum, but has, in recent years, experienced an even more dramatic price trajectory. Also used primarily in catalytic converters, palladium's value spiked as global emissions regulations tightened and supply chains struggled to keep up. Between 2016 and 2020, palladium prices quadrupled due to persistent supply deficits. At certain points, it even traded higher than gold, driven by its indispensable role in modern vehicle manufacturing. Energy resources are the backbone of the global economy, and their prices are heavily influenced by a web of geopolitical, environmental, and economic factors. Crude oil, often referred to as the world's most critical commodity, powers transportation, industry, and even agriculture. Its price history reflects its strategic importance and volatility. In 2008, oil hit nearly $150 per barrel amid soaring demand, only to crash during the global financial crisis. More recently, political tensions, production cuts from oil-producing nations, and supply chain bottlenecks have led to unpredictable price swings that affect everything from inflation to transportation costs. Natural gas, another vital energy resource, plays a major role in electricity generation, heating, and manufacturing. Unlike oil, natural gas prices are often influenced by regional factors such as weather conditions and local infrastructure. A harsh winter in North America, for example, can cause natural gas prices to spike as heating demand surges. Additionally, production levels, storage data, and global trade flows also significantly affect its pricing. Industrial metals are foundational to modern development and infrastructure. Copper stands out as a key indicator of global economic health due to its widespread use in everything from construction to electronics. As the world shifts toward renewable energy and electric vehicles, which require far more copper than traditional technologies, demand for this metal is expected to rise substantially. Copper prices tend to rise during economic booms and fall during downturns, making them a useful pulse check on economic momentum. Aluminum, known for being lightweight and corrosion-resistant, is another essential industrial metal. It's used in everything from cars and airplanes to packaging and consumer electronics. Its production, however, is highly energy-intensive, making its price sensitive not just to supply and demand, but also to energy costs. Disruptions in mining or smelting operations can also create sharp price movements, especially given its widespread industrial use. Agricultural commodities are at the heart of food systems and global trade. Corn is a versatile crop used in livestock feed, ethanol, and human food products. Prices are heavily influenced by weather patterns, planting and harvest forecasts, government policies, and global demand shifts. Similarly, soybeans are a critical crop used for oil, protein-rich animal feed, and various industrial applications. Their market value reacts to many of the same factors, with additional sensitivity to international trade flows, especially demand from major importers like China. From an investment standpoint, commodities offer a hedge against inflation. Historically, assets like gold and silver have risen in value when inflation eats away at the purchasing power of fiat currencies. During the 1970s, for instance, when inflation soared, gold prices followed suit, rising sharply as investors sought refuge in tangible assets. Commodities tend to show a negative correlation with traditional assets like stocks and bonds during such periods, offering a layer of diversification in a portfolio. If dealing with physical property isn't your thing, try equipment leasing. Got a drone, 3D printer, or camera gear? Businesses often need equipment, but don't want to buy it. That's where you come in. Let's say you lease your 3D printer for $500 a month to 3 businesses. That's $1,500 per month, or $18,000 per year. Equipment leasing is a smart and increasingly popular way to generate income from high-value assets without the hassles that come with property ownership. This model leverages the ongoing demand from businesses that need access to specialized tools and machinery, but want to avoid the large upfront costs of purchasing them. As more industries lean toward operational flexibility, leasing provides an appealing solution that benefits both the lessor and the lessee. While drones, 3D printers, and camera gear are some of the more familiar examples, the equipment leasing space is vast and includes a wide range of high-demand categories. In construction, for example, companies regularly lease excavators, bulldozers, cranes, scaffolding, and generators for project-based use. Rather than investing heavily in machines they might only need temporarily, they choose to lease and avoid concerns about storage, maintenance, or depreciation. Lease rates for such heavy machinery can vary widely. A mid-sized excavator, for instance, might rent for anywhere from $2,000 to $5,000 per month. In the medical field, the costs and rapid evolution of technology make leasing especially practical. Hospitals and private clinics often lease expensive equipment such as MRI machines, CT scanners, and patient monitoring systems. These devices are vital, but often too costly to purchase outright, especially for smaller practices. A top-tier MRI machine, for example, could yield a leasing income of $10,000 to $30,000 per month, depending on features and usage terms. Office equipment is another strong leasing category, particularly for mid to large businesses. While desktop printers are typically bought, larger and more specialized devices, like high-volume commercial copiers or large-format printers, are commonly leased. Monthly lease fees for such equipment can range between $300 and $1,000, providing steady returns for the lessor. Technology and IT infrastructure also offer fertile ground for leasing. With technology advancing so quickly, many businesses lease high-performance servers, networking hardware, and computing systems to avoid being stuck with outdated tech. Leasing a full server rack setup, for instance, could bring in anywhere from $500 to $2,000 monthly, depending on the configuration and the support services bundled in. In the manufacturing world, companies frequently lease industrial machinery such as CNC machines, robotic arms, and injection molding systems. These machines are expensive and require technical maintenance, making leasing an attractive option for users and a potentially lucrative one for owners. Income in this space can vary significantly, ranging from $1,000 to tens of thousands of dollars monthly for advanced systems. Transportation-related equipment also fits well into the leasing model. Items like forklifts, pallet jacks, specialized trailers, or even small aircraft are frequently leased by logistics, warehousing, and supply chain companies. A heavy-duty forklift, for instance, could bring in $500 to $1,500 a month, depending on size, capabilities, and leasing terms. Then there's the events and entertainment industry, where the need for professional lighting, sound systems, video gear, and special effects machines is often temporary but essential. These items can command high per-event rental fees. A professional lighting setup for a concert, for example, could yield several $1,000s in income from just a single booking. Looking at the broader picture, the global equipment leasing market is a multi-billion-dollar sector, driven by industries like construction, IT, healthcare, and manufacturing. Lease rates are influenced by the original cost of equipment, its expected lifespan, frequency of use, and market demand. Profitability in this space depends heavily on smart acquisition, efficient maintenance, and keeping utilization rates high. Lease contracts can be structured to suit various business needs, ranging from short-term rentals to long-term commitments. While the lessor is usually responsible for maintenance and insurance, some agreements shift these obligations to the lessee. Still, It's essential to factor in these costs when pricing leases. Another key consideration is depreciation and obsolescence. Since many types of equipment lose value over time or are overtaken by new technologies, it's important to ensure your pricing covers the long-term wear and tear. To scale in this field, lessors often reinvest profits into acquiring more in-demand equipment. There are now platforms that connect equipment owners with businesses seeking to lease. But industry-specific networking also plays a big role in building steady clientele. As an example, imagine investing $30,000 in a high-end industrial 3D printer. By leasing it to two prototyping firms for $800 each per month, you generate $1,600 in monthly income or $19,200 annually. Subtract $1,000 per year for maintenance and insurance, and you're left with a net income of $18,200. An impressive return that highlights just how profitable equipment leasing can be with the right strategy and demand. Here comes a secret weapon: your network. Believe it or not, your connections are an asset. One of the most underrated yet profoundly impactful assets in any individual's portfolio is his network. While it doesn't appear on a traditional balance sheet, a strong and well-nurtured network can open doors, multiply opportunities, and accelerate both personal and professional success. In many ways, your network is your secret weapon, an intangible resource that can yield very tangible results when leveraged with intention. Consider how networks uncover investment opportunities that others never even hear about. Imagine you're at a casual networking event and meet someone launching a promising tech startup. Because of that personal connection, you get early access to invest, something that wouldn't have been available through public channels. That's privileged access, powered by your network. Similarly, if you run a freelance marketing business and meet the owner of a web development firm at a conference, your network just created a new revenue stream. By teaming up, you can offer clients a comprehensive solution, web design plus marketing, and take on larger, more lucrative projects. Networks are equally powerful when it comes to job opportunities and contract wins. Many high-paying positions or freelance contracts never get publicly advertised. They circulate quietly within trusted circles. A LinkedIn message, a warm introduction, or a simple conversation can uncover a role that fits your skills perfectly. And there's data behind this. Studies have consistently shown that candidates who come through referrals are more likely to be hired and tend to stay longer in their roles, making networking an essential job search tool. Beyond income and opportunity, your network is also a reservoir of knowledge. Say you're venturing into crypto investing and don't know where to start. A contact with expertise in that space could provide clarity, resources, and even warn you against common pitfalls. That one conversation could save you both time and money. In another scenario, if you're trying to grow your artisanal coffee business, a connection might introduce you to someone who runs a major office complex. And soon, your brand is featured in every break room. That's real, measurable growth catalyzed by your network. And then there's mentorship, one of the most valuable long-term benefits. Imagine being a young professional and connecting with a seasoned executive through your alumni network. Their guidance could shape the trajectory of your career. Likewise, online communities within your industry can act as crowdsourced think tanks. By simply sharing a challenge, you might receive unique solutions and ideas from others who faced and overcome the same problem. Your network becomes a living, breathing, problem-solving machine. While it's hard to put a precise dollar value on the ROI of a strong network, qualitative and indicative data tell a compelling story. LinkedIn's own analytics reveal that users with larger and more active networks see more job offers and business inquiries. Referral-based hiring continues to outperform other recruitment channels in quality and longevity of hires. Early-stage investors often find promising startups through their connections. And sales professionals routinely cite networking as a cornerstone of their success. One asset that's often ignored: your wellness. Physical and mental health are your foundation. Physical wellness is more than just looking good. It's your energy source. It's what fuels your ability to work efficiently, think clearly, and pursue opportunities with stamina and focus. Studies have shown that regular physical activity enhances memory, problem-solving skills, and concentration. That's not just good for your health. It's a performance booster. In fact, physically active individuals can be up to 15% more productive. That's time and energy you can reinvest in your business, career, or personal projects. There's also a direct financial incentive in staying physically fit: fewer doctor visits and lower medical bills. Preventable chronic conditions like heart disease, diabetes, and obesity cost Americans billions each year. According to the CDC, these conditions account for a significant chunk of national healthcare spending. Taking care of your health today saves you serious money tomorrow. Then there's resilience, the quiet superpower behind every successful person. Building wealth isn't a straight path. You'll face setbacks, market fluctuations, and personal challenges. But when your body is strong and your energy levels are high, you're better equipped to keep pushing. Add to that the benefits of good sleep, one of the most overlooked productivity tools out there. Quality rest improves decision-making, boosts mood, and sharpens your ability to respond to stress, all of which are critical for financial judgment and long-term consistency. On the flip side, mental wellness is the compass that keeps you grounded. A clear, focused mind allows you to make smarter decisions, from investing and budgeting to choosing the right business partners. Stress, anxiety, and burnout don't just feel bad, they skew your judgment. Behavioral economics has repeatedly shown how emotional states affect financial behavior. Panic leads to bad trades, fear makes us overly conservative, and burnout steals our ambition. Let's not forget motivation. Mental wellness gives you the staying power to keep showing up, even on the days when life feels heavy. It keeps you disciplined, focused, and in the game. Burnout, on the other hand, leads to procrastination, inconsistency, and missed opportunities. From an economic standpoint, the cost of neglecting wellness is staggering. Burnout alone leads to reduced productivity, higher absenteeism, and rising healthcare costs, affecting not just individuals, but businesses and economies as a whole. That's why companies are investing heavily in wellness programs, because the ROI is clear. Healthier employees are more productive, more loyal, and less expensive to insure. Mental health also has a broader impact on workforce participation. Untreated mental health conditions can reduce a person's ability to work, grow, and contribute economically. On the flip side, addressing mental health needs increases participation, engagement, and performance, not just for individuals, but for society at large. So how do you invest in wellness practically? Start with sleep. Treat it like the non-negotiable asset it is. Aim for 7 to 9 hours of restful sleep each night. Eat a balanced diet, rich in whole foods that fuel your body and brain. Move your body regularly, not as punishment, but as self-respect. Whether it's walking, swimming, dancing, or lifting, find a rhythm that works for you. The CDC recommends 150 minutes of moderate activity per week, and it's well worth the return. Manage stress proactively with tools like deep breathing, mindfulness, yoga, or journaling. Even just spending time outdoors can help reset your nervous system. Strengthen your social connections too. Having strong, supportive relationships is one of the most powerful predictors of long-term mental well-being. And don't hesitate to seek professional help. Therapy isn't a weakness, it's a tool. Just like you'd go to a doctor for your physical health, talking to a counselor or psychologist can be transformative for your mental wellness. Set healthy boundaries to protect your time, energy, and emotional bandwidth. Learn to say no without guilt. And finally, practice mindfulness. Cultivate present moment awareness so you can stay grounded, reduce overthinking, and focus on what matters most. That's it from today. Thanks for tuning in, and remember to stay tuned and subscribe for more inspirational ideas. Until then, bye-bye.